so we'll go ahead and get started. Thank you everyone for joining us today for the mortgage meeting. We're here to discuss the ins and outs of the pre-approvals and some other important details about the loan process when you get a mortgage. We're going to dive deep into a lot of those different details. And if you have any questions, please comment below. We'll look out for them at the end. And if we don't see them immediately, we will respond to them after the meeting. So feel free. So today I have joining me Billy Slobin of the Slobin Group and the Mortgage Link. Billy's a mortgage branch manager who started in the mortgage industry in 1985. He has closed over $3 billion in mortgages and has been nationally ranked in the top 200 of loan originators. He has a team that helps him provide the quality service borrowers deserve on every transaction. So thank you for being here, Billy. And I hope we can get some good questions in.
Yeah, thank you for having me today, Patrice. It's a pleasure. Always love to do projects like this with my partners, and working with you is terrific. And here at the Slobin Group, we just love what we do. I absolutely have enjoyed being in this position for going on my 38th year in the business. I started when I was very, very young, and it's been a great run, but I'd say it's about halfway over. So I got a long way to go and a lot of more people to help. And every day's a blessing and a fun time helping people achieve this goal.
Yeah, Billy is definitely in top of my list for preferred lenders to use. I'm a very particular person, especially when it comes to the loan process. So if I have someone on my list, that means they're definitely good. And it probably means they love what they do, because I think if they don't love what they do, there's always
It
going to be a
shows.
problem.
Yeah, it shows when they don't love what they do.
Yeah. So we'll get right into it. So first of all, what is the pre-approval letter for people who don't know?
Okay. So a pre-approval letter is a letter generated by a thorough and committed, you'll hear those words over and over, loan officer team that attests that the client making the offer can actually not only make the offer, but close the transaction. A real pre-approval letter, and this may be answering something from later on that you asked, but whatever. A real pre-approval letter means that the loan officer has reviewed the client's income documentation, whether that be a self-employed or 1099 person, which would necessitate deeper dives, or a W-2 person. It means the loan officer has examined and calculated the income. They have looked at and reviewed the credit. They have looked at bank statements, and they have verified that this person making the offer can actually close the transaction. Ideally, the pre-approval has been not only, I'm probably answering stuff from later in the question, but which I'll try not to do. It means a thorough job has been done vetting the client, and that I can assure my realtor partner and the buyer that with this letter, I have looked at what I need to look at, and we'll talk about more of it later. And I know this transaction will work.
Hey, it's
I don't hope it will work. I know it will work.
So what's the difference between the pre-qualification letter and the pre-approval letter?
Okay, so a pre-qualification letter is a letter thrown out there by countless companies who, for various reasons, because they don't want to spend the time, because they don't want to spend the money, because they don't have the resources, they give a pre-qualification letter, which means the borrower told them some things, they told the borrower some things, and yeah, sure, you can go buy that house. But they may or may not have looked at a minimal credit report, maybe a soft pull credit report, or not. And so many of the pre-qualification letters say stated, use that word stated by the borrower, meaning they didn't email, upload, or convey their pay stubs, bank statements, tax returns, W-2, whatever their personal situation is, it really means the work has not been done. I
And
guess we're back to it may. May's not a good word.
no, especially when you're trying to buy a home and you're spending time finding it.
Yeah, the realtor is spending time. The realtor
And
is
underwriters,
showing houses, which gas is extremely expensive. And the realtor's reputation, if the realtor wants to make an offer for this person, it's their reputation. They're bringing them, and a savvy listing agent's going to look at a pre-approval letter and a pre-qualification letter, and they're just going to throw it in the gone.
yeah, and then if we get far enough, I mean, the buyer's going to be disappointed if, we get down to it and they actually can't buy the house and they spent money on and time on inspection, appraisal,
$1,000 right
making,
off the bat, right?
making
Or so.
decisions, thinking that they're going to close, and then they
Yeah,
won't.
yeah, not a good thing.
Yeah,
Inefficient.
yeah, definitely. So going into that though, a lot of banks and credit unions, they may have gotten, everything they need to get, but they will still call it a pre-qualification letter instead of a pre-approval letter. Why do you think that is?
Yeah, I think that's just semantics in their compliance and marketing departments, possibly. If somebody has a pre-qualification letter, but there was income docs, asset docs, full credit report. I say full, not soft. All reviewed, all automated, underwritten, all underwritten. At that point, a pre-qualification letter is just that word qualification versus approval. But if everything below it was done correctly, then there's no difference in that case. But the truth of the matter is that's seldom the case.
Mm. Yeah, I mean, whenever I have a listing, I have offers, whether it's one offer or several, for my sales make a decision, I definitely call the lender
Loan
and
officer.
ask them, yeah, loan officer, loan originator. Um,
They should have called you, but then that's just me.
Yeah, some will call me. That's good. But
Yeah.
I
Yeah.
call every time, no matter what the deal looks like. I want honesty.
Right.
If they got everything great, if they didn't, what did you get? And then it's up to my sellers, right? But last
Yeah,
thing I
for sure.
want a lender that's gonna say, yes, we got everything, and they actually have nothing.
That's not good. So, I mean, I guess to summarize the final answer on that question is if the letter says pre-qualification as opposed to pre-approval, but yet below it, it says, I have verified A, B, C, and D, and you call the loan officer and they respond, I got the W-2s, the pay stubs, the bank statements, I've run through automated underwriting, so on and so forth, then that was just the way their company wanted the letter, had the top of the letter to look, and it is no lesser. But that's seldom the case.
Good to know. And so going into that as well, what are the specific documents needed for a buyer?
Okay. So let's assume that the buyer is a W-2 employee. We would want a full month of pay stubs. We would want full 30 days of pay stubs. We would get 2 years of W-2 forms, not tax returns. We would get 2 months bank statements, all pages, please, even the blank one at the back. If it's conventional, if it's FHA, only 1 month bank statement. Copy of a driver's license, copy of a 401k if applicable. And I mean, if the person owns a house that they're trying to keep, we'd get a mortgage statement, homeowner's insurance. If they're going in without a previous property, that's about the whole list. And when I say bank statements, 401k, any asset vehicle. So, I mean, if they have IRA, they have a brokerage account, all assets, because we show all the liabilities. You might as well show all the assets. Copy of a driver's license. Now, if the client is a 1099 employee or a self-employed person, that changes because they typically don't get pay stubs. So you're going to get all the same asset stuff, but you're going to get 2 full years of tax returns including any 1099. If there's multiple, you got to get them all. And if they're self-employed, straight up, no 1099s. You're going to get 2 years of tax returns, all schedules, all the pages, not Michigan, but federal, everything. And depending upon the time of the year, you're probably going to need to get a year-to-date P&L, profit and loss, which is really not an audited document, but something from their accountant saying, okay, this much gross is brought in this year, this much expenses have been paid out, just to show that this person continues to make money, qualify for their new home.
So, some things you said in there, I understand, but depending on who's going to watch this, they may not fully know. So
Sure.
break down, for one, the difference between FHA and conventional. I don't think that's one of my questions on here.
Okay, so a conventional loan is a loan that is ultimately guided by the agencies, Fannie Mae or Freddie Mac. A conventional loan typically requires a higher credit score than an FHA loan. That's just different loan vehicles with different guidelines. The minimum credit score on a conventional loan is technically 620. However, you're not getting approved for a conventional loan with a 620 credit score unless you're putting 45, 50% down. More likely when you're putting 3%, 5% down, which is way more common, you need to be 700 and greater on your middle credit score. And if you're trying to get down payment assistance, such as MISHDA, which that's a whole nother conversation. We should do a down payment assistance video separate of this. So if you're getting down payment assistance, meaning $10,000 from the state, you have very little of your own money invested, possibly very little of your own money in the bank, higher risk loan, the automated underwriting system is going to look for higher credit scores than it would if you were putting your own 10, 20, 30, 40% down. That's why when you're looking at a conventional 3% down loan, 5% down loan, 3% down payment assistance loan, the computer is going to look for a significantly higher credit score and also some strengths to the file, job stability, reserves, meaning money left over in a bank or a 401k, because they don't want to see it be that skinny, that thin, with no margin for error. An FHA loan is a loan that is backed by the government completely. HUD is the Housing and Urban Development, Federal Housing Administration. It is a 3.5% down loan, fixed rate loan that has, let's just say, more insurance on it, both upfront and paid monthly, allowing people to buy houses who have lower credit scores, even as low as 580 if you have all of your own money or most of your own money. There still can be a gift or a seller concession, but no down payment assistance. And keep in mind that on all these loans, they have to go through an automated underwriting engine and be approved. So you can have a 580, a 600, a 620 and still not be approved if the computer doesn't sense enough strength. And there's only so many hours in our presentation here to go deeper into these things. And I'm happy to do it anytime. But so an FHA loan is really, for a lot of people, it's the loan they take on their first house, but not too often on their second or third, if that's the way it goes. And over the years, I've put many people into their first purchase on an FHA, refinance them into a conventional loan product because time went by, rates improved, their scores were higher, they were more financially stable, and more money in the bank, however you want to say it, higher equity position because the house went up in value. So sometimes you start out as an FHA person. About my first house FHA, I won't say which year. and refinance into a conventional loan very quickly afterwards. So it's just different loan types enabling a greater portion of the population to buy a house and achieve home ownership. There's also VA loans for veterans of the military. There's USDA loans, which is rural development loans for people buying in certain zip code, certain address driven areas. Those again are also another conversation. On an FHA loan versus a conventional, you qualify for up to 55% of your gross income, which really sounds like and is a lot because we're talking gross. Conventional loans max out at about 50%. But again, this is all governed by the referee, the automated underwriting engine, who is going to sense the strength of the file and only let it go as far as the computer thinks it can work reasonably.
And real quick, can you give examples of, for some people who aren't sure, assets and liabilities?
So assets would mean that matter, because a house doesn't matter. A classic car or a car doesn't matter. Gold doesn't matter. Basically money in a checking, money in a savings, money in a brokerage account, money in a 401k, assuming it's has some sort of liquid vehicle to it, can all count as assets. Gift funds from a relative can count as an asset. Liabilities would include car payments, student loans, credit card balances and minimums, and any installment loan, anything that shows up on your credit report. What's not a liability? Your previous rent, which is a question I was asked recently, because that's going to go away. Your cell phone bill, even though it may show up on the credit report, that doesn't go into your debt to income ratio. Your gas or electric, that doesn't. A previous house you own, yes, if there's a payment on it, and homeowners insurance, taxes, those do go into your debt to income ratio, though they can be eliminated or negated by a lease and proof of receipt of rent if you're, for instance, moving out of it. Other liability, I mean, cars, boats, your girlfriend's motorcycle, your girlfriend's boyfriend's motorcycle. This is all real stuff. I don't make it up. Your girlfriend's your boyfriend's husband's motorcycle, jet ski, quad runner, boat, all these count.
Okay.
So be careful. Don't co-sign for people.
Yeah.
Don't do it. Don't do it. If you do co-sign for people, and I'm going off track here, Patrice, you make the payment yourself. Let them pay you. You set up an auto pay, because that way nobody can ruin your credit, because they ruin your credit. It's bad enough that there's that debt on there that's causing you a problem. And when they don't pay it, at least you pay it, set up an auto, and have a set up an auto from their account, bank account, into your bank account, so that they pay you. But even if they don't, at least your credit doesn't get destroyed. I've had a lot of people thank me for that strategy, because it all comes true.
Yeah, no, that's definitely good advice. So still a seller's market, and it's definitely crucial, even more so, for buyers to be pre-approved if they want to get their offer accepted.
Yes.
For the most part, I mean, with my business, I've never written an offer without pre-approval proof of funds, but I guess years ago, some people used to write an offer and not send anything.
Yes, they did.
So
in the old days, Patrice, I hate to interrupt you, but in the old days, prior to say 2007, 8, 9, people would come to us with a purchase agreement all the time.
That's it.
Without, I mean, our previous clients, and in 07, 08, I'd been in the business for over 20 years. So I had a lot of previous ones, and they were smart, and they read my newsletters and my advice, and they would come to me and say, Billy, pre-approve me, even though it wasn't a thing necessarily yet, because they wanted to know before they made an offer on a house how much it's going to cost to move in and how much the payment is, because they were smart. But in those days, we would get tons of people coming to us. Here's a purchase agreement. What's your rate? Well, and before I can give you my rate, I have to look at your statistics. And it was I mean, many times we would have to tell them, well, you don't qualify for this house that you already made an offer on, got accepted, paid an earnest money, got an inspection, not an appraisal yet, but you don't even qualify for it unless we get your uncle to co-sign or whatever, or you put way more money down that has to come as a gift. It was the wild, wild west.
Yeah, it's hard for me to even imagine that being the normal because
It
I mean
was,
you
yeah,
waste so much time trying to sell the
yeah,
house.
crazy.
And the
But
buyers would be frustrated at the end of the day too.
but in those days, if an agent could get their hands on and their hooks in a person who was willing, whether they were able or not, they were pressing forward.
Yeah.
Wow. Yeah. Crazy days.
Yeah, well, I guess just now we just have different problems, right?
We
So,
did. Yes. No houses.
so I guess just in general, with it still being a sales market and pre-approval being the normal situation anyway, can you just talk about how, you know, them being fully pre-approved versus, you know, when they're competing for a house, right? It's a
Yep.
big war and your
Yep.
buyer is fully pre-approved while the next buyer may not be.
Yep.
Can you express how that's worked out very well for you or success or a success story on that?
Very well. So when a client comes to us, and I'm gonna go down two forks, two different roads for you here. When a client comes to us, the very first thing we do, once we kind of go through all the vetting questions and get them to the point of wanting to fill an application and provide the documents, we explain to them that it's crucial that I get all these things from you, both for your sake as the buyer, so that you know the two most important numbers on earth. The interest rate's not an important number, and the sale price of the house is not an important number. The only two numbers that truly matter: what's the monthly payment and how much do I need to bring to closing? Because those are real. Sale price is not a real number. Interest rate is not a real number. Doesn't matter. It just doesn't make any difference. What is my monthly payment that I will write out of my check in my paycheck? What is the upfront amount? You would be shocked, Patrice, at how many lenders, I'm not going to call them competitors, lenders don't provide the people with that information up front. Even if they go to the length of getting the correct docs, even if they go to the length of pre-approving them properly, they're still not properly preparing the buyer, because at the end of the transaction, they got to come bring the money and they got to be able to make that monthly payment, able to and wanting to, comfortable doing it. So you put extra time and work into giving your agent referral partner back somebody who's educated on this process. They got through all the part about the papers, and a very huge and very common objection from people as well. This company didn't ask for any of that. And I'm not going to name any of the names. If you want to, you can. They didn't ask for that. Why do you guys need it? And you don't want to give them a facetious or sarcastic answer, but trust me, you want me to have all that so that I can make sure that your $500 appraisal and $500 inspection don't go to waste. So you get them to the point where they come back to you armed with knowledge. They're armed with a worksheet that shows them those important numbers. When you go to make an offer, and invariably, so many of these transactions, there's going to be 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 25 offers. Well, a smart listing agent knows to make some phone calls, even though Slobin Group, and I'm doing a commercial here, we call outbound on every offer that our agents follow my instructions, which are: when you find our mutual client a house that they want, you send my right-hand man, Steven, the address, the price you're going to offer, so he can tailor numbers to that offer. Beyond that, send me the listing agent's name and cell and street name you're offering on, and I'm going to call them on Sunday night at 10 o'clock if need be, and explain to them how we processed the pre-approval and how it differs from the other ones they're looking at. And the smart ones are like, oh yeah, I got 3 others, but first of all, I've called the loan officers, they don't answer the phone. And it doesn't say anything on that letter that makes me comfortable.
Mm.
So this is what gives our buyers, our clients, an advantage. You got to put in a little, like anything else, you put in the work up front, you're more prepared for the battle.
Yeah. So a lot of buyers don't understand that getting pre-approved and then applying for their mortgage, they don't know the difference between, like when they apply for the mortgage for a specific house versus getting pre-approved.
Okay.
So explain what
So,
the difference is.
yeah. So getting pre-approved, we do what we just said we're going to do. But then they send us an address and we do a worksheet showing them this specific property. Then you make an offer. Then I call the listing agent and they accept it. Now it's time to apply for your mortgage. Okay, well, we explained to them that you applied for a pre-approval. Applying for your mortgage means we are now going to update your file. We're getting new pay stubs because you got to make sure they're still working. We're getting a new bank statement. I'm not going to talk about credit report dates because I guess that's later in the talk. We are updating your file and we are going to send out electronic disclosures, government stuff, so to speak, that you're going to sign. And once you sign them, we're going to send you a link to put in your credit card information so that an appraisal can get ordered. Because this stuff's not done over the phone anymore. Everything's done through a portal. Now you're applying for a mortgage. So this week, I had a few people who converted from pre-approval to, accepted offer, pressing ahead. Before we turn in the file, so to speak, to have disclosures sent out and to have an appraisal, link request sent out, we're going to require the borrower to freshen the file for us because we don't want to turn in a file with month-old pay stubs, with a month-old bank statement. We want fresh stuff so that the processor and or the underwriter don't have to request, hey, I've approved this loan conditionally, but I need new pay stubs, new bank statements. We freshen the file before we turn it in. So that's basically the applying for a loan versus it's just bringing everything up to date. And now that there's actually a transaction in a property, we're adding in that fourth component. There's income, there's assets, there's credit. Now there's collateral, a house. So we're adding that fourth component and they're going to pay for an appraisal and the appraisal is going to, show everybody that the house is worth what the bank is loaning on, what the client is paying for. That doesn't include appraisal guarantees and things like that. That's a whole nother discussion.
Yeah. I mean, the other thing too is, it makes it so that you can actually close on time or sooner because you've already done the full
Yes.
approval versus run a contract. And now I want to get everything else that I didn't get already.
Yes. Because time is of the essence. Even people who aren't in a hurry are in a hurry. Everybody's in a hurry. So the more we can have in the file up front, the more complete of a submission we have, the less touches, the less time the file's got to be reviewed. I had a conventional client who was very, very astute and sharp, and she closed. PA date was March 29th. Inspection was done April 4th, green light, and she closed 7 days after that.
Oh, wow.
So that was because of her.
Yeah. Well, that's the thing too.
Efficiency.
I've had 2 deals this year where, the inspection was a long time,
Yeah,
because we're hooking up on one thing and we need that to be solved. And fortunately, because they both of those buyers, send their stuff right away, they're prepared, we actually close on time.
Yeah, and that helps. Borrower cooperation is a giant cog in this wheel. motivation.
Yeah, I mean, obviously, the more people we have involved that have everything together, the easier it is for
Yes.
everybody, but that's
Yes.
not everybody.
Yes.
So what is an underwriter's job?
Underwriter's job is to make sure, let me get rid of this icon here. Underwriter's job is to make sure, to ensure the integrity of all the documents in the file. An underwriter is one who, it used to be in the old days, old days, the file, when it was complete with an appraisal and the docs would go to committee. That
Mm.
word committee, old time realtors would, their eyes would perk up when you say committee, because a file would be put together, sent to committee, which could include, a couple of underwriters, a manager, boss person who would review the file. Now, since probably the 90s, there's automated underwriting, AUS, automated underwriting system. So a file is inputted by the loan officer team into an automated underwriting engine. Documents are put with it. The file is uploaded. A processor can also be an underwriter, meaning a processor can be a licensed underwriter as well. They go ahead and look over the docs, run the file back through automated underwriting, cross check everything to make sure everything's, as it's supposed to be. The line between a processor and underwriter used to be very distinct. The underwriters were over here. The processor would package up a file with the 4 categories: income, assets, credit, collateral, and give the file, send the file, courier the file, fax the file to an underwriter. Now the lines are blurred between those two jobs, because pretty much real, quote unquote, real processors, professional processors, they're underwriting the file, and then they're giving the file to an underwriter to look at and say, here's my findings, my automated findings, here's my docs, please review and sign off.
Okay, so you answered next question, but is there anything you want to add to the processor's role?
The same thing. Their processor can be, I guess you could add to it, they coach the loan officers, they coach the smart loan officers who want to be better and better as to guideline changes. Used to be managers dropped guideline changes on us. Now more so processors share with loan officer teams, loan officer assistants, changes we may want to be aware of, utilization of software. Very frequently they convey information to our team. I'm going to see if I can just read you some highlights, which will actually make it make sense. So let me see if I can get to this. Of course not. So a processor may say, okay, here's the update. The guidelines for this program have changed. Credit scores higher, the credit scores lower. The new MISTA guidelines came out. Income's higher. Please see the attached matrix for the new ones. Please use this credit site instead of the old one. So they're kind of I guess the processor is the go-between between the loan officers and the underwriters. Loan officers don't really talk to underwriters. I think that's it, and in the old days as well, processors and loan officers worked in the same office,
Hmm.
steps apart. And it was always better in the business. Everything got better as you separated them. One, so the processor can do their work. And two, so that you can be a little more organized on your conveying information from this team to that team. I just want to read you one email that I thought was would illustrate what a processor does real quick here. And Here we go. So this morning, we got an email from our processing manager. Good day. Here's a recap of information we sent out last week, all in one place for your reference, making sure the loan officers are on it. Make sure that you run this program only through Loan Prospector, not Desktop Underwriter, because it's going to Fannie Mae, not Freddie Mac. Changes in where to find different documents in a drive. These are things that processors coach loan officer teams and individuals on now. That was used to be done by like a manager type of person. This is a processing manager, but they've eliminated in the industry people who don't really have tremendous real functions. So processor kind of works with the loan officers, coaches them, illustrates for them how they want files put together, and the underwriter is the final checkoff person.
Okay, sounds good. So, you talked a little about desktop underwriting, but I know some loan originators, they'll rely on the desktop underwriting for pre-approval, while others will, actually take it to human underwriting, is what you would say.
Yep.
So why do you think that is?
Well, a desktop approval is when a loan officer inputs or uploads the info the client provided into a automated underwriting engine and runs, quote unquote, runs it through for an approval. And that is better than not doing so. But what we do is we do that, then we upload the file to the processing and underwriting teams. They do what I had mentioned earlier. They check off and look at the integrity of what if the income was calculated wrong? So we call it a TBD pre-approval. When we pre-approve somebody, we get all their info, put it together, upload it into the underwriting portal. Processors look at it, make sure everything is there, push it based on the scenario of the person, push it to the underwriting team. They underwrite it so that you don't run into a problem later in the process. See, because you can run into a problem later in the process if the upfront information wasn't, I mean, hourly employees, it can get funky calculating their income.
Yeah.
So you got somebody who works at Ford or Chrysler and they make $25 an hour. Should be real easy, right? But what if for 4 of the months last year, they worked 15 hours a week? Year-to-date incomes need to be matched. There's so much more to it. Not everybody is just a straight salary or an hourly wage earner, but working 40 exact or more every week. Sometimes there's variances. And if somebody doesn't look at these things closely and carefully, you run into a problem. So a pre-approval that's been pushed inside, so to speak, and reviewed by processing / underwriting is a much more thorough pre-approval.
Yeah, I mean, is it kind of like when someone's getting, trying to get a credit card, and if you do it online, they may get denied because it didn't match the algorithms, right, of what was needed for
That's
that.
possible. Yep.
Or
Or they put in their monthly
realistic,
income instead of annual by accident.
yeah,
Details need to be looked at.
yeah. So I guess the question on that is, if you went through, I mean, you had the conversation with the buyer, and maybe you already knew from your experience that, oh, on the desktop is going to make it a problem here because of X, Y, and Z. Would you then still take it if they got denied with the desktop to the underwriter?
Well,
Say,
there is a such thing as a manual underwrite, but there's like a whole different set of criteria on a manual underwrite. You have to meet a bunch of guidelines, a certain credit score. And a manual underwrite more often is when maybe there's some late payments on a credit report that the computer won't approve them, but there are compensating factors, reasons that even though the computer may not approve them, a live underwriter may look at it and say, well, yes, they did make their car payment late 6 times last year, but they have proof that they made it on time. They have canceled checks, but yet the credit bureau can't fix it. Didn't fix it. won't fix it. So it looks like they have this problem, but they have 80 grand in their 401k. And I can look at their bank statement and see the car getting paid. So that's just one of a million stories that could possibly take place. But so, yes, not super common, but it does happen.
Okay. And so why do different loan officers or loan originators have different timelines of how long their pre-approval is good for? You know, one may say a month, one may say 3 months, one may say 4 months.
Well, because they go by different maybe they go by the aging of a different document. Like a credit report expires after 90 days. So let's just say, for example, I pre-approve somebody today, and 45 days from now, their house hunt is heating up. You may want to get a new credit report because that one you have is not going to carry you through a closing date. So some people base it on probably, and I couldn't speak for every lender, on when the credit report will expire. If there's a 30-day one, it's just because pay stubs expire after 30 days, bank statements expire. Different companies may have different, whether it's criteria or hot buttons on when they want to refresh something.
Okay.
So, I mean, if you give somebody a pre-approval and the credit report is valid for 90 days, what if after 50 days they pick out a house, want to make an offer, and I've seen this in real life a million times. Oh, but I bought a new car. And they weren't one of the smart clients who called me up and said, Billy, I'm going from a 300 to a 600 car payment. You can never be careful enough. Has anything changed? You're going to make an offer. I ran your credit report March 1st. It's now May 1st. So it's 60 days old. There's only a month left in it. Has anything changed? Well, because I'm going to need a new report before you close. Well, what if I pre-approved them and they had their balances down on their credit report, all under 30%, and they had a 644 credit score? And they're getting down payment assistance. But then they ran their cards back up. And when we rerun it, because the old report's not going to carry us through closing, it'll need to get ordered. Well, now they're at 75%. Their score is now 610, and they don't get the $10,000. So there's no way you can ever be careful enough.
And how do you handle the buyers or borrowers that are always concerned, like, well, if I don't find a house by then, I need to get my credit run again. I don't want to do it. You know, they're worried that they're screwed.
Sometimes you have to be blunt, honest, and transparent and say, well, then you're not going to make an offer.
What's more important?
Yes, exactly. And the thing is, we do a soft pull initially on everybody. We only escalate to the hard pull, which is the one you can't run a file through an automated underwriting engine with a soft pull. It just tells you where two of their scores are, and it helps us advise them or help them decide, are you ready for a real credit report? So down the road, I mean, there's people there. We have 800 credit score clients, right? When they go 45, 50, 60 days into their window, we know these people and we know them very well. We're not running a new credit report. Nothing changed. They know, they're, sorry to say, a different breed of people, but a different breed of people who have their stuff together, so to speak. When you have an accepted offer, we'll run a new credit report. But they're not borderline people. You have to be able to judge who's here and who's here, because if somebody barely squeaked through the system versus somebody with a very large stable income, a very large asset base, and consistently over 5, 10, 20, 30, 40 years of 800 credit scores, you have to be able to look at what the person's situation is in order to determine how deeply you're going to scrutinize them in the shopping window.
Makes sense.
Got to know your clients, you got to
Yeah,
know your clients.
yeah.
Pay attention.
So, locking in the interest rates, when can they do that, and how long is usually
When
the
the
lock?
file is turned in and the appraisal's ordered, 30 to 45 days. Longer the rate lock, the higher the rate.
Oh, okay.
Slightly.
And so, when let's say they don't close in that 30, 45 day period, and it's a matter of do I want to pay to extend the rate, the lock break, or the lock rate, locking the
Yeah,
rate in, or do I
yeah.
want to wait and see and gamble? How do you determine that with the client?
It's very, these days, a very rare occurrence. Very rare, but basically we clear to we locked you in at X interest rate and we clear to close you, and the seller's agent never ordered pre-title and they got 6 months of screwing around to do, which I've ran into a million times. Basically, we have to email our marketing department, find out what the cost is of relocking the rate, and seller's going to need to pay it. But we don't go from locked to, okay, we're going to play the market again for 2 months. But it really doesn't make a lot of sense to relock until there's an end to the process. Meaning, what if it's going to take 3, 4, 5, 6, 7 months? Which I've seen that happen because the seller situation was so messy. Heirs, estates, probates, whatever, undisclosed situations. The rate lock is never blown out by us because it's just not. If the buyer blows out the rate lock because they didn't provide things timely, that's their cross to bear, so to speak.
Okay. Oh, so yes, often in the loan approval process, meaning they've got an offer accepted and they're in underwriting and processing. Buyers get frustrated, need to send documents over and over again. If they claim they've sent before, they aren't understanding why I sent it a month ago, why I have to send it again. What was I gonna say? Yeah, can you explain, I guess, better for them? Well, I put it myself. Is it correct that for items such as bank statements, that buyers need to send updated statements as time progresses,
Yes.
where the buyer is still making the same money and no surprises have shown up?
How would we ever know that? How would we know they didn't empty their bank account? How would we know they still have that they didn't work 20 hours instead of 40 unless we get new bank statements and pay stubs?
Yeah,
I have to tell you, Patrice, people complain about that. Not the savvy borrowers, though, not the smart ones.
I understand. Yeah.
But the people complain about it. I have to tell them that, listen, you're buying a house that costs $100,000. You're putting in 3,000, which you're actually not because the state's putting it in. My company's putting in 97,000. Put yourself in those shoes and you're loaning somebody the money. Would you want to see the updated stuff?
Yeah. When I do
So
my
sorry, but that's the truth.
yeah, when I do my buyers consultations now, to avoid or to help, right? Because if they don't remember what I said or whatever, but to help avoid the frustration and them calling me and they're asking this again, and writing all this stuff, because they're thinking like, I'm buying a house. You're getting paid me to buy this house. I'm expecting you to give me customer service like when I go shop for a car, when I shop for a shirt or a pair of shoes. And I tell them if they look at it as I'm asking to borrow money from someone, it'll be much easier. It doesn't matter if your score is 800 or it's 600. This is what's required. There's not a way around certain things. And so if it's being asked for, you have to send it. And if you wait and don't send it, you're not going to close on time. So they ask for
Very
it,
good.
send
Very
it.
good to yeah, it's very good to point out to them. And I mean, I'm gonna speak very bluntly here, and I'm gonna speak from experience. The people who have 800 credit scores, they email you a nice, neat PDF with their new pay stub, their new bank statement. Let us know if you need anything else. The people, I'm going to say this very nicely, who don't have an 800 credit score are going to email you an upside down backwards screenshot of their uncle's old pay stub from 82. They're going to send you the wrong stuff. They're not going to send you their stuff. They're going to say they sent it, but the computer portal tells us if you sent it or not. And if you're emailing it, you know,
Yeah, I had a deal a couple years ago where, first of all, I had to do the loan originator's job at the end of the transaction, but I had to have the client come to my office and scan everything in because he didn't have a computer to even properly send a PDF. It was going to be a picture no matter what, and then when, like you
you
say, you get the
can.
picture, you can't read it. So yeah, it can
Well,
be frustrating.
I have a lot of realtor partners who understand that their clients, for whatever reason, even though they have a $200,000 student loan, still can't do a PDF or scan. I don't know how that fits together, but it's a real thing. And between myself and the agent, I email the agent the document request as well, because they're going to be seeing these people and I'm not. And they have them bring the list to their office and they scan them to me happily so that they don't have to hear it, so that I don't have to hear it, and so that we can get to the goal line, which is the ultimate goal, much quicker.
Yeah, that is a part of it. Makes a big difference of closing on time.
Yeah.
So
And teamwork is everything.
yeah. So once you pre-approved a buyer for a particular price range, is it accurate to say the major reason you to review a home of interest determine their monthly mortgage payment, even if it's in the price range they're pre-approved for? Is it usually because of their taxes and your
Taxes and insurance. Taxes and insurance. I mean, you can have a house and you can pre-approve. When we pre-approve somebody, we say you're good for a 250 house, up to a 250 house with no more than X in taxes and insurance. Okay, so 3,000 taxes, 1,000 insurance, fourth payment plus $4,000 or whatever. So they could come back to us and they could say, well, we decided to buy a house in the city. Cool. But yet the listing doesn't have the taxes proper. You have to calculate them using the millage rate, and that 250 house that in Westland, Redford, uh, Warren, wherever, and has $4,000 in taxes, the 250 house in the city has $11,000 in taxes. And the homeowner's insurance is $3,000. So all of a sudden, it doesn't work. So those are the taxes insurance primary driving factor behind skewing numbers, so to speak. But what we do to deal with this, when you're making an offer, we tell with every pre-approval letter that goes out and cost worksheet, sample cost worksheet that goes out with it, please do not make an offer without sending us the address so that we can make a new worksheet and say, yeah, the 250 works, but the 11,000 versus the 5,000 in taxes is an issue. You don't qualify, or you do qualify, but now your payment's going to be this, not that.
yeah, and then also like if it's a condo, right? And they have HOA fees.
Yes. Yep.
Okay. What's the best way for a buyer to determine if they're getting the best loan options with the lender or loan originator that they trust without getting their credit pulled with different lenders?
You know, that's a hard one. I'd say pretty much the water all comes from the same well. This lender can have a eighth higher, eighth lower interest rate. You can't really shop for mortgages without having a file. So I think you have to. There's an old saying that you have to dance with the partner that brought you to the dance. You have to decide who you trust and feel comfortable with, because it's not the 1980s or 90s where you're just going to call 86 mortgage companies and they're going to tell you what their interest rate was. And whoever told you what you wanted to hear is who you're going to go with. I think you have to decide based on referrals, based on integrity and reputation, who you're comfortable with. And I think that's it. It's again, just like things have changed with all these different categories we talked about, how things were done 10, 20, 30, 40, 50 years ago, 5 years ago. I think the old fashioned rate shopping thing, it just doesn't work the way, because in the old days, we would get rate sheets faxed to us or emailed to us. And if you got approved for a loan, that's the rate. Now there's credit score adjustments, loan to value. There's so much criteria that you have to upload a file into a computer, including uploading a credit score into a computer to get accurate rate pricing. So I guess the best way to put, after explaining it that way, it's just not the 90s anymore, where guys working at offices, automotive company offices, would have a spreadsheet with 200 lenders. And for their whole 10 days, 10 hours a day at work, they would call hundreds of lenders and not work. And I think the bosses at Chrysler, Ford, and GM put an end to that.
Yeah, that's a lot.
What it was back then.
Yeah, I mean, I think the like and the trust part, I tell people, is really important. Obviously, someone that if you need down payment assistance, first of all, they have to have the program. Otherwise, that's going to make a big difference for you.
And the state sets the rate on those anyway.
Yeah, but the like and trust part, I say, is just as important, and sometimes could be more important in the long run,
Or
because the reality is, people don't like this part of the process anyway.
right.
It's already
Right.
complicated and
Yep.
requires a lot of effort on their part. And so if they don't like the person, to make it that much more difficult. And if you can't trust
Right.
them, you're not going to send them what you need, or you're not going to rely on what they're telling you, and then you won't close on time. And they can hinder you in getting the house or not. Like you said,
Yep.
you get an offer, and if I get an offer and I can't reach the lender, I'm not going to probably accept the offer, because if you can't even answer the phone in the first place, when it's time to do the
Right.
work, you're not going to be there.
Right.
So the last question I have is, when is the best time for buyers to reach out to a lender or a loan originator, however you want to phrase it, to discuss getting pre
Okay.
if they want to buy
Well,
a year from now?
so it's an interesting question, because I have clients who are repeat clients, second house, third house, whatever. The person I described earlier, super solid income, super high credit score, asset base. Those people always reach out to me as much as a year in advance, because they're organized people. Hey, Billy, I know what I need to get to you, but can you run some numbers on this for me? Could you soft pull my credit to make sure no errors have taken place? I know I don't know anything on any of my credit cards. I only have one car payment and a house payment, but I want you to look over my stuff so we don't run into a problem down the road. Super smart people. Okay. Anyone else, I would tell them, come to me a year in advance and let me do a coaching session. Because sometimes trouble could take a year to fix, could take 10 years to fix. But a year is a smart time frame. Do a soft pull, pre-qualify them, look at their credit, look at their how much you make, how much your debts. Pay this off, pay this down. You have a year to accomplish this. If you come to me 3 months before or 6 months before, you have half the time to accomplish these goals. So the longer in advance, the better, if they take the coaching.
Yeah, I mean, I tell people now, if they
Takes
call
away the stress. Yeah.
because even if they're ready to buy now, but they don't want to buy it till next year, there's stuff they don't know, because what your credit report is going to see, which, unless it's experience, is what I've told, it could be different than what they're seeing on their end in the first place. And
Yep.
they may want to improve, even if they are ready to go, right? They may want to improve
Yep.
because
You
they
could go
want
from
a better
FHA to
rate.
conventional in that window, which means you can now buy a condo. Maybe you want a condo. Maybe you have a mid 600 score. In 5-6 months, you may not be able to get it well over 700. But in a year, you can accomplish that, and opens up more doors for you.
And also knowing how much you're gonna be willing to spend per month, right? You
And
may
how
be
much you
looking
should save.
online.
Yep.
Yeah, you're looking online at $300,000 house, not knowing what your monthly payment's gonna be. And then if you don't know until 6 months ahead what your monthly payment could be, and now you don't
Yep.
want to spend 300, now you don't
Yep.
have an option for the house you want, and got to figure out your
Yes.
in, or so. Yeah, okay.
Better to be prepared.
Well, that's all I had. Did you have anything else that you wanted to add?
Yeah, if anybody would like honest information, knowledgeable information, transparent information, and real coaching to prepare yourself for this or for your kids, coworkers, whoever, give me a call, Coach Billy Slobin, 248 535 0465. You can direct message me on Facebook. I imagine there's a that'll be on there, Patrice, or you could reach out to Patrice and she'll connect us. But if you want help from real people who answer the phone, who return phone calls, and have knowledge they're willing to share with you, get in touch with us.
All right. Well, thank you so much for your time. This was a lot of good information. People who are bought a home before or they haven't, ins and outs of the pre-approval process and getting you to your next home. And so I hope everyone has a great day. And I thank you again for Billy for your time. And I will talk to you
You're
soon.
welcome. You did a great job, Patrice.
Thank you.
You had the hard job. Yeah, you did great.
Thank you. All right. Have a good
Okay. All right. Talk to you soon.
Okay. Bye.
Okay. Bye-bye.
If you've enjoyed watching this video and would love to stay up to date when I have more content like this or something similar that you may be interested in, please like and subscribe to this channel and click the bell so you get notifications. And I hope you have a great day.